Hi guys, and welcome back to Tesla Electron. I hope you've been having a fantastic week. Here I am at Euroa on just over the New South Wales border, about 100 kilometres or so, and there's a 6-stall supercharger here and it's pretty good. Amenities straight across the road. We'll have a look around, see if there's some food. We'll let you know, but it looks pretty good. Pretty awkward to get into coming in from the roadway. It's just like a little driveway, so that's about it. But today's video I'm going to talk about Leo Kojuan's email to Martin Vicha about Tesla doing a stock buyback. Will they do one? Won't they do one? Let's get into it. Come on right up. Okay, so let's get straight into it. So what prompted the buyback discussion? Kojuan, Leo, Tesla's third largest investor, sent an email to Martin Vicha, as I said in the intro, urging Tesla to do a 15 billion stock buyback. You can see the Twitter comment there from Kojuan. Although Martin has redacted the reply, according to Kojuan's Twitter, Martin said he would forward the email to the board, as you can see there. Kojuan suggested a 5 billion this year and a 10 billion next year, particularly as the stock prices dropped so dramatically. Before we start, a cautionary note. Tesla states the following on their website. Does Tesla pay a dividend? Question. Does it plan to? Question. Then their answer is this. Tesla has never declared dividends on our common stock. We intend on retaining all future earnings to finance future growth and therefore do not anticipate paying any cash dividends in the foreseeable future. And you can go to the Tesla website to see that. But what is a stock buyback? A stock buyback, also known as a repurchase, takes place when a company decides to buy back its own shares from shareholders, generally with accumulated cash that is sitting on the balance sheet. Or the company may borrow against other assets should the company need to do so. For example, during a hostile takeover where they need to increase the ratio of shares held by the company to maintain control. A stock buyback is a way for a company to invest in itself, demonstrating to the market that it has confidence in its long-term future and improve financial ratios in the process. The purchased shares are absorbed by the company. The company may choose to cancel them or keep them as treasury shares, and the number of outstanding shares on the market is reduced. Because there are fewer shares on the market, the relative ownership stake of each investor increases. How does a company conduct a buyback? Well, first of all, they might do a tender offer. The company shareholders receive a tender offer that requests them to submit or tender a portion or all of their shares within a certain time frame. The offer will state the number of shares the company wants to repurchase and a price range for the shares. Investors who accept the offer will state how many shares they want to tender along with the price they are willing to accept. Once the company has received all the offers, it will find the right mix to buy the shares at the lowest cost. Act 2. They might do it on the open market. A company can also buy its shares on the open market at the market price. It is often the case, however, that the announcement of a buyback causes the share price to rise on speculation, as the market will see this as a positive move by the company. Now, there are 4 main reasons for a buyback. 1. To boost the undervalued shares. When a company sees its shares being depreciated against its expectations for its share price, then it may execute a share buyback to try and boost the share price. In this scenario, a company is demonstrating to its shareholders that they believe in the company's long-term success and value, and they wish to signal this to the marketplace. The company puts their money where their mouth is, as it were, using their own cash on hand as collateral to confirm their belief in themselves, which hopefully gets the market players back on their side. 2. It may increase the EPS, or the earnings per share. Now, another reason for a share buyback is to increase the earnings per share of the specific stock. This happens because of the reduced available shares causes a scarcity for the stock, generating supply versus demand. This is fairly simple arithmetic. If you remove outstanding shares with the stock repurchase, the fewer numbers of shares that the company earnings or profits will be distributed to. Hence, the earnings per share increases. An increase in the stock's EPS often leads to an increase in the stock price, which adds value to the investor. It typically creates a higher demand for the shares as well, which is another benefit if you already own the stock. You can determine the EPS of a share by the following equation: the net income minus preferred dividends divided by the end of period shares outstanding. And you can see the equation written out there. You might ask, what is a preferred dividend? A preferred dividend is a dividend that is allocated to and paid on a company's preferred shares. If a company is unable to pay all dividends, claims to the preferred dividends take precedence over claims to individuals that are paid on common shares. So a preferred share is like somebody who got in early on the IPO and they bought, or they might have even got in before the company IPO. They've already got shares in the company, so they become a preferred dividend holder. That's my understanding of it anyway. If I'm incorrect, please let me know in the comments. A real life example of an EPS would be a company that has profit sharing with 5 employees currently. In January, let's say they had profits of $1,000 to split between 5 company employees, or $200 each. The company realizes that one of the employees really wasn't working out, and they let that person go. In February, the company has profits of $900, less than January, but the distributions are only to 4 people, so they still receive $225, a rise from the previous earnings per share. And you can see that in the diagram there. Reason 3, manage number of outstanding shares. Now, another one of the reasons for a share buyback is for the company to be able to manage the number of shares outstanding. This is somewhat like the reasoning in reason number 2 about increased EPS, but slightly different at the same time. Remember, a lot of companies give out stock options at bonus time or as compensation to high up executives, as Tesla famously does for many employees. And while they see the value in them, they have nothing at stake to claim the funds. So a typical investor like you and I invest our own money for the long term, and we are not trying to time the market. We find a company like Tesla that we want to invest in, take our own capital, buy the stock, and let it ride until generally a specified time period in the distant future or retirement. However, executives who receive large chunks of stock options typically don't have any reason to hold their positions. Elon has historically held his stock, but we are seeing him use that stock for other purposes recently. The bottom line, large chunks of the stock options can be cashed out, making the number of outstanding shares in the market much greater, as is the current situation with Tesla stock. In order to maintain optimal levels of outstanding shares, companies can participate in a share buyback to anticipate a large sell-off. While a share buyback can pop the stock, a large sell, as we have seen recently, can also devalue the stock price. A share buyback allows the company to play defense more than offense. And you can see my little diagram there. The company offers share options to somebody, an executive like Elon. He then decides whether he is going to keep or sell those shares. And then if he keeps them, the company doesn't have to worry. If he sells them, however, they go out into the open market and they may flood the market and devalue the share price, which we have just seen happen. Reason number 4 for a buyback is to simply reinvest in the company. Cash on the balance sheet is the least valuable asset. You've probably all heard the saying, cash is trash. Particularly at the present time when inflation is at all-time highs, any cash sitting in the bank is being devoured by inflation. Of course, there needs to be enough liquidity and cash reserves to pay for general expenses and a little extra for any extraordinary events. However, for example, Tesla has $18 billion sitting on the balance sheet. That's probably not actually earning anything. Most likely it's being eaten at around 7 to 10% per year in inflation. This may be Tesla's best reason for a buyback, just so that its cash is not eaten by inflation. In saying that, I believe that Tesla and Elon have major expansion plans moving forward, and they may need that cash. I'm not on the board, and Tesla will certainly know better than anyone how to allocate their resources effectively. The company may not have any great opportunities to purchase assets to expand their business, so they may reinvest the cash into themselves by buying stock. Now, typically these share buybacks happen in the range of hundreds of millions of dollars. So even if a major corporation like Tesla can earn 1% on their savings, a small stock pop or even 5% can pay an additional 4% on their money. Using 100 million as the example amount of a buyback, that creates an additional $4 million for the company in additional profits. And Tesla has 18 billion. If they do a 5 billion this year and a 10 billion next year, they could gain substantially from that. This is obviously on a much grander scale than our cash accounts. However, reinvesting company cash or free cash flow to generate high returns for that cash asset is yet another great reason for a company like Tesla to do share buyback.
So hi guys, I'm back from my travels. I've done 1,700 kilometres over the last couple of weeks, and so we've travelled down to Melbourne via Canberra, down and then back. But in conclusion to whether or not Tesla will do a buyback, let's talk about that. You know, there are other reasons for a stock buyback, and however, I suspect that these ones that we've discussed are the most common. And if you know of any others, please let the community know in the comments below. Do you think that Tesla will do a stock buyback or another split? From my perspective, either would be good for my portfolio. A buyback would probably increase the stock price over the short term, but whether it will have any long-term effect is, look, it's anyone's guess. It might give the stock price some legs whilst Elon is doing his Twitter thing. A stock split, on the other hand, would lower the overall stock price, especially if it were a 20-to-1, as I've mentioned on a previous video up here somewhere, or up here. This would give more potential for growth as the stock would go up in value over time. Being that I believe in Tesla's vision for a sustainable energy future, I'd be extremely happy with a stock split instead of a buyback. But at this point, I'm wondering if Tesla will do either this year or wait until the financial markets become more stable, possibly in 2023 and 2024. Only time will tell, and no doubt we'll hear something on Twitter one way or the other in the coming months. So let me know in the comments which of the two options would you most prefer and why, or if you believe Tesla won't do either. Don't forget to like, share and subscribe, and again, a great thank you to all of my new subscribers and my Patreons. I really appreciate every one of you, and I do comment back on your comments, so please comment down below.
Have a look at these videos. YouTube think you'll love this one.
You know that you'll want to. I'll see you on the next video. And don't forget, stay charged. Bye.